This is Kenny Tian. Welcome to Real Estate License in 14 Weeks. This is episode 40 of Starting from Zero. We start with chapter 14. If you like my video, please give me a thumbs up, subscribe to my channel, hit the bell for further notifications, and share this video with your friends. Valuation and Appraisal Part 2. Today we're going to talk about the different approaches to appraisal. First one is called sales comparison or market data approach. Now it is important to remember that these names are interchangeable because you might be thinking of sales comparison, but sometimes in the exam question they will use market data approach. So you have to remember both names. Now for this particular approach, the following are the important factors that will influence your analysis. Number one, financing terms. You have to make adjustments for the following. In the case of financing terms, let's say, for example, you got three comparables. Two of them involve loan terms with lenders. The third one might involve seller financing. Oftentimes, where the transaction involves seller financing, it could be that the seller will give a very favorable financing to a buyer. For example, in the case of a buyer who does not have the ability to qualify for a loan. So in order to buy a particular property, that buyer can't get loans from a lender. But if a seller who happen to have a difficult property to sell is willing to provide financing to the buyer, in this particular instance, quite often the buyer is willing to pay a higher price if the seller is willing to give seller financing. So if the appraiser knows that that particular transaction involves seller financing, the appraiser would have to adjust the price downward a little bit because the buyer probably paid higher than the fair market price because he was able to get seller financing. The second type of adjustment is called conditions of sale. Conditions of sale refer to the seller's condition of sale. Now, was the seller under any kind of pressure to sell? If the seller was under some kind of bankruptcy, or the seller was in foreclosure, or it was a short sale. Short sale refers to a situation where the seller could not afford to pay the mortgage and worked out a deal with the lender such that the lender will lower the amount of the payoff. For example, if the property is worth $500,000, but the borrower owes the bank $550,000. So obviously, in order to make the sale, the lender would have to discount the amount of the loan from $550,000 to $500,000 to make the sale work. So this is what we call a short sale. Now, in the case of a short sale, a seller don't have any incentive to get the best price because whatever amount of money that comes in from the sale, he doesn't get anything because the lender will keep the extra money. In the case of a short sale, because the seller does not have motivation to sell, price tends to be lower. So if a appraiser knows that a comparable was for a short sale, the price would have to be adjusted upwards to make that kind of adjustment. So the conditions of sale is also another adjustment. Third adjustment is called the market conditions. Market conditions refer to the times of sale of the comparables. Let's say you got three comparables. One comparable was sold in the last month. The second comparable was sold 3 months ago. And the third comparable was sold 12 months ago. Now, most likely, there will be no adjustment needed for the comparable that was sold a month to 3 months ago because it was closer in time. But for the comparable that was sold 12 months ago, an adjustment will have to be made. If it's a rising market, now the one that was sold back 12 months ago would have to be adjusted, assuming that the present value will be higher than when it was sold, so it will be adjusted upwards. So that's a kind of adjustment that an appraiser would have to make based on the market conditions. The fourth kind of adjustment is called the location adjustment. Assuming a property is located 1 mile from the beach, and then there are three comparables. One comparable is located also approximately 1 mile from the beach. Another one is located 3 miles from the beach, and another one is located 6 miles from the beach. So if an appraiser wants to use these comparables, the appraiser would have to make adjustment for the one that's located 3 miles and 6 miles away, because the further it is from the beach, the lesser in value. The closer to the beach, the higher is the value of the property, generally speaking. Now, because the first comparable is located 1 mile from the beach, which is the same thing as the subject property, which is also located 1 mile from the beach, there is no adjustment needed. Adjustments are only needed to be made on the one that is 3 miles from the beach and the one that is 6 miles from the beach, which means that the prices for the 3 miles and 6 miles distances from the beach would have to be adjusted. It would have to be adjusted downward because it is lesser in value. Fifth kind of adjustment is called physical characteristics. The appraiser would have to make adjustment for things like the size of the living area, whether it has pool or not, and all the upgrades, amenities, and also adjustment will have to be made based on all the upgrades and based on the number of bedrooms and the number of bathrooms. This is what we call physical characteristics. Lastly, an adjustment would have to be made on the income characteristics. The better in terms of the income characteristics, the higher the price of the property is. The lower in terms of income characteristics, the lower the price. So if the comparable is of a lower income characteristics, then the price of the comparable would have to be adjusted downwards. Now, income characteristics only refer to income property. It does not apply to non-income properties. The next approach is called the cost approach. In the case of cost approach, two very important concepts. First important concept is called reproduction cost. The second important concept is called the replacement cost. In the case of reproduction cost, an appraiser would have to come up with a cost to create a replica, which means that the exact same material as the subject property. So if it is an old building that has asbestos as the building material, then the appraiser would have to come up with the present cost of asbestos, assuming asbestos is still allowed in the construction of new building, which I doubt. But if a type of material is still available, then the appraiser would have to find out the present cost of that particular specific material in order to come up with a cost that will reproduce the exact same building. Now, obviously, the cost of material has gone up so much since 50 years ago. So if it's a very, very old building, the cost approach is not very reliable because it is difficult. Number one, for two reasons. Number one, availability of the same material. Number two, the cost of the material is so much different from when it was built years ago. Whereas the replacement cost approach refers to construct of the building using materials that are equally desirable. Not exactly the same. I'll give you an example. Years ago, floors were made of hardwood floors only. Those were years and years ago. But in the modern days, you have laminate, for example, or engineered wood. Those are not exactly hardwood floor, but they are equally desirable. So if you use the replacement cost, you will probably end up with a lower number than if you were using the replacement cost, because hardwood floor is a lot more expensive these days than years ago. Years ago, hardwood floor is a lot cheaper than now. So that's why the replacement cost, which generally will give you a more reasonable number. The cost approach is most particularly used in service buildings such as city hall, church, and schools, because there are no readily available comparables. That's why for this type of buildings, most likely the appraiser would have to use the cost approach. Now, the cost approach is most accurate and most reliable for new buildings, because if you do a cost approach on newer buildings, the cost of material is easily available, and the costs that are used for to do a replica of a newer building will most likely be very close to the actual cost of the material at the time it was constructed. The square footage method is commonly used in the cost approach. That means that it is suitable for single-story buildings such as single-story residences, warehouses, and other types of single-story buildings. The square footage method make use of dollar per square foot to construct a building, such as $150 a square foot or $100 per square foot. For example, in the case of a residential property, the dollar per square foot to construct the garage is probably smaller or lower than the dollar per square foot to construct the living space. This is the end of episode 40 of Starting from Zero. See you next time.